everyone. It's Laura Mayer, and welcome to our podcast on joint venture agreements. This is the first episode in a series, and we'll be discussing management rights. Who's running the show? So, in this series, we really have three different audiences. We have operators and developers, capital providers, and attorneys drafting and negotiating joint venture agreements on behalf of their clients. Throughout the series, we'll use different terms like operator and developer on the one hand and capital provider on the other hand. And what I really mean by that is the operator and developer is the one that has sourced the deal, whether it's off market or they found the deal through a broker relationship. They've put together preliminary pro forma. They have the investment thesis and they're looking for outside third party capital. And then on the other hand, we have the capital provider. Their main goal is to maximize returns on the capital they've been entrusted with, either for their own family or for their own investors. And they are not interested in getting involved in the day-to-day. They have deep pockets. They are writing checks probably not just to this one JV, but to many. They're diversified. And capital providers come in all shapes and sizes, right? You have the private equity funds, you've got institutional capital and life cos, you've got family offices, ultra high net worths, you've got universities. I mean, the list goes on and on. So, the type of JV that I'll be talking about is one where you've got one operator kind of running the day to day and really running the deal, and then a somewhat silent capital provider. There are many different structures that are different from this structure. Okay, you could have two co-equal 50-50 partners, both bringing equity and expertise in management. You could have a diversified capital base that's all outside limited partners, but they're more friends and family. And you're doing this in a big syndication where each individual LP has less control. Separate situation, right? That's separate from this series. This series is really two-party negotiation where you have an operator developer and a capital partner. So before even getting into the terms of the JV, you want to know, who are you partnering with? Who is the capital provider you are partnering with? What is their fund life cycle? Where are they in the fund life cycle? And on the contrary, as a capital provider, you want to know who is the operator, right? How many deals like this one have they done? Who are their prior capital providers, and what was the experience? What was their experience working with them? Um, had many clients call me and say, "Hey, I know you did a JV with so and so. What were they like to work with?" Right, and not not asking about any terms of the deal, but asking how they were day to day in you know managing and running a deal, right? And I've asked that of my clients, past, present, former. When I've got a new deal for a new client, and I know such and such is across the table, I will ask clients that I know have done deals with that person and said, "Hey, did they really penny pinch on every little thing? Do they really want approval over all this stuff in the practice of it?" Right? The terms say one thing, but in the practice of it, what are they like? So in management, there's really three main structures that I've seen. I mean, there's a lot more, but these are the buckets of kind of the the main options, right? These are the things that people understand. Um, First is the capital provider as the sole manager. They are the legal decision maker of the entity. Second is the operator as the manager, with the capital provider having major decision rights. And the third is a hybrid approach where the capital partner gets to be manager on paper, with the operator as administrative manager or having some sort of signatory rights. It's a way for the capital partner to have legal authority for the entity, but the administrative manager having the ability in the day to day to sign documents. I will say number two is probably the most common, where the operator is the manager and the capital provider has major decisions. There are different reasons why different capital providers have different requirements on this front, right? Their investor base may require them to be in control of an entity, or for tax reasons, they may need more control rights or more management rights than other capital providers need. But number two is the line. If I had to go in and draw a JV out of a hat, it would most likely be structured as number two. And then I would say the footnote to all of this is that there is a theoretical fourth option of the the operator being the sole manager and the capital provider having no rights. But in my experience, when you're working with a capital provider providing most of the equity, if they have any sort of representation at all, that's never going to happen, right? So that would be very rare. It's perhaps possible if you have a friends and family syndication, and and all the LPs are just silent with no rights at all. Yes, but that's not what we're talking about in this series. We're talking about one pool of capital as the capital provider, one operator. Within option 2, here is a sample list of major decisions. 1, admission of new partners or members, or mergers and acquisition type activity. 2, affiliate contracts. 3, bankruptcy and bankruptcy related actions. 4, financings and refinancings. 5, sales and dispositions. 6, annual budgets, annual plan, development plan, annual operating plan. 7, material contracts. 8, reserve amounts. And with this, I'd probably also put timing of cash distributions. 9, appointment and removal of officers. 10, litigation and settlement of litigation. 11, use of insurance proceeds. And 12, construction specific items for where your business plan involves construction. This list is not exhaustive by any means. And as you could probably tell by just reading some of them out, some of them are clearly more important than others, right? If one party has the right to admit new members and dilute all prior capital contributions, that is a problem. That is a very big problem. The other party will always want consent over that, right? But maybe approval of certain vendor contracts under a certain threshold or over a certain threshold, that's where, is it really essential? Does it cut to the core of the investment and what that investment is worth? Or is it just a nice to have? So, going a little more in depth on the first 6 items of the list: admission of new partners, corporate type matters. This is what I was talking about before with dilution, right? You've invested $100,000 in something, or in the case of a JV like this, probably more like $10 million in something. So you want to make sure that new partners cannot be admitted later on better terms, even the same terms, and dilute you when that was not the plan, right? You always wanted this percentage of this entity, and so you don't want that to happen. It's pretty self-explanatory. Same with merging or forming subsidiaries or reorganizing entities. This cuts to the core of what your entity, what your investment is. We think of investments in real estate as investments in the dirt, and often forget that investments in real estate through structures like this are really investments in entities. And so those entities need to be preserved, need to be upheld, need to be, protected. And that's what these types of major decisions falling under this item comprise. The second is affiliate contracts. So these are contracts where one party is doing a deal or signing a contract with an affiliate entity or person within their family, or you name it, right? So it's party A deciding, hey, my affiliate's going to be the property manager and they're going to take a 4% fee. The other party, the JV, will always want to approve of those affiliate contracts because it is essentially a drain on the cash flow of the JV. So that line item protects against that. And often there will be pre-approvals of certain affiliate contracts that everyone knows are in play at the beginning. Often property management agreement, asset management agreement or asset management fee, construction management agreement, construction management fee, things like that. Bankruptcy filing. Kind of goes without saying, you don't want your partner to file bankruptcy for the entity without consulting with you and getting your permission. Financings and refinancings, as well as sales and dispositions. So This cuts to the economic thesis of the project. So at the outset, everyone pretty much should agree on the business plan. They should say, okay, we're going to do XYZ to the property, we're going to lease it up. Then in year whatever, we're going to refinance, take some cash out. Then in year, later, we're going to go sell the property and make all this money. Things change, of course, and the economy changes, circumstances change. Things take longer than they expect, or shorter. You get some short wins, and there's an opportunity to cash out early. The parties may have differing objectives in terms of their investments and their return profile. One may be optimizing for just you the equity multiple. One may be more IRR driven, and this could lead to differences in opinion on what one should do in terms of financing, refinancing, and selling. On the financing part in particular, there's a subset of major decision under this for any financing that would incur guarantee liability. That would be kind of like a more fundamental, at a fundamental level. Financing should not be incurred without the party who is guaranteeing having consent over that financing, unless they've agreed at the beginning that they were going to be the guarantor. Annual budget and operating plan, as well as project budget and operating plan. Basically, every year, both parties kind of agree on the plan. And if a plan is not approved by the capital partner by a certain point in time, the prior year's plan would apply, except for variances. So, for just non discretionary items like taxes, insurance, things that can't be changed, utilities, those automatically get increased the next year by the increase that you can't control. For the other stuff, like, who do we want to do our landscaping? Are we going to hire the top of the line guy or middle of the line? That type of stuff is typically within a certain variance. So between 3 and 5% of last year's budget would get approved for this year if the other partner didn't approve. And then for project budgets, kind of the same idea, although it's not on an annual basis. For project budgets, the key thing is allocation of cost savings. So how are cost savings being allocated, and how is contingency being used? Does the capital partner get to approve use of contingency in the budget, or is it just the operating partner running the show? You'll need to look at the GC agreement to see what the GC's flexibility is. And then on top of that, you should have an additional layer of project level budget where the operating partner can or cannot reallocate cost savings at the project level among different line items without approval. All right, material contracts. So this one is where capital partners vary a lot in practice, but the terms in the JV often are more onerous than they actually require in the day-to-day. I've experienced this on the ground as both a developers counsel and on the private equity side. So private equity always has these nice requirements. You have to use the standard form, you have to have XYZ requirements, and anything over, say, 25,000 needs to go through the private equity's legal. Sometimes it doesn't happen. Sometimes the business people on the private equity side wish it doesn't happen. So operators often go through their day-to-day signing these things, especially if it's in line with the budget, without private equity approval. We're not the police here as lawyers, but just be aware that sometimes these types of provisions do not always get enforced. Material leasing, of course, capital providers are going to want to approve that. Property management agreements, leasing agreements, any sort of material contract, like for a hotel, franchise agreement, something like that. Of course, material needs to go through approval. Reserve amounts, these are cash reserve amounts that the manager can withhold from net cash distributions. So you'll have sometimes the manager can unilaterally reserve for known and unknown liabilities. Sometimes they need approval. And along with this, if there's a set timing schedule for distributions, then you'll just follow that schedule. But if there's not, often the capital provider will want to approve the timing of distributions as well. Officers and key persons. Normally, this isn't a hot button topic on major decisions, and really the manager should be able to appoint officers, except if they're performing certain key functions or they're a key person, if a key person is being replaced. Litigation and settlement of litigation. Things like evictions and routine slip and falls, things covered by insurance, capital providers really don't want to get involved with that. But if it's a material dispute that has bubbled up to litigation that could have some exposure, certainly the capital provider would want consent over that. Insurance proceeds, of course, the terms of the loan agreement, if there is one, and or ground lease and underlying documents would govern as a first line of analysis. And then going up to the owner level, what are we going to do with insurance proceeds? Are we going to rebuild? What do our leases say? What do our loan documents say? But if a decision is to be made, the capital provider wants a seat at the table. For development projects, there are certain construction-specific major decisions that are often included, and they include appointment and contracting with the general contractor, the main architect, and often the main engineer and other design professionals, as well as major changes to the plans and specifications for the project. Now, if when you enter into the JV, the plans and specifications are not fully developed, you may have additional design development provisions in the joint venture or in a separate development management agreement where there's, a design development phasing schedule. So you've got design development documents, conceptual schematic documents, you move down to different levels of completion of construction documents until all the documents are approved. And then, of course, any changes to those plans and specifications would come back to the capital provider for approval. So here we have the dueling battle of perspectives. From the operator's perspective, this person was hired or this company was hired to do a job, to maximize returns, to really be the eyes and ears on the ground, and they don't like being second guessed. They want to go and they want to run with it. Their incentives are to maximize investment performance. They're normally getting a promote interest, and we'll cover that in a subsequent episode, but they are incentivized to do high performance in order to get high returns on their efforts. And then from the capital provider's perspective, they often are living within certain constraints from if they're a fund, from their fund documents. They can't do certain things or go in certain territory. They're constrained in that way. So they certainly would want to get approval rights over those types of things. And then, they want the legal right to go and step in should there be a problem. Most capital providers prefer to partner with trusted operators that they know are going to do a good job and that they can be very hands-off, especially some of the business principals I've worked with in private equity. They don't want to be in the weeds on the day-to-day. They want the operators to handle it. Here are a few suggestions to bridge the gap on some of these heated debates that come up over major decisions. The first is, instead of using terms like material, use a specific dollar amount. Instead of saying the capital provider gets to approve all material contracts, say all contracts over $10,000 in any one instance and $50,000 in the aggregate when combined with all other contracts that capital provider has not approved in the year. Deemed approval concept. So if the capital provider does not approve within a certain number of days, you can have a structure where it's deemed approved. Sometimes capital providers will want a second notice with boldface type saying, warning, this is a second notice. If you don't approve, it will constitute your deemed approval. Emergency carve-outs, pretty self-explanatory. If some emergency happens that threatens someone's safety or physical assets, then the operator can act without the capital provider's approval. And finally, line item flexibility within a budget. So the operator may be able to go over a certain line item in a budget within a certain variance. And that concludes today's episode on management rights and JVs. Thanks for joining me. If you like this podcast, get excited because we've got a stellar lineup of episodes for you here on the screen. Look forward to joining you in the future. Take care.